It starts with a notification you can't quite believe. You check your bank app. It's not loading. You try the ATM. It spits out a message, unable to process. You walk into the branch. The doors are locked. What would you do if your bank suddenly failed? No warning. No heads up. Just gone. Sounds like a nightmare. But for thousands of Americans, this has been a real experience. And if you think it can't happen in today's world, think again. Let's talk about what really happens if your bank fails and what you can do right now to protect your money. Number one, what does it mean when a bank fails? Imagine running a lemonade stand. You borrow money from your parents to buy lemons, sugar, and cups. But if no one shows up to buy your lemonade and you can't pay your parents back, you're out of business. That's what happens to banks. They take your money and lend it out to others for mortgages, business loans, or credit cards. But if too many people want their money back at once and the bank doesn't have enough on hand, the whole thing collapses. This is called a bank run. When a bank fails, it basically means it doesn't have the money to meet customer withdrawals or financial obligations. It's broke. In 2023, Silicon Valley Bank collapsed almost overnight when customers withdrew over $40 billion in a single day. Number two. So, is your money gone forever? Surprisingly, no. This is where the FDIC comes in. The Federal Deposit Insurance Corporation insures your money up to $250,000 per depositor, per insured bank, per ownership category. It's like a safety net. If the bank crashes, the FDIC steps in and makes sure you still get your money. So if you have $200,000 in your checking account, it's fully protected. If you have $300,000, only $250,000 is guaranteed, unless you split it into separate insured accounts or use multiple banks. The FDIC has protected Americans' money since 1933. Not a single person has lost insured money since then. Number three, what happens the moment your bank fails? It usually starts on a Friday. The FDIC doesn't want to cause panic, so they quietly take over the bank after hours. Over the weekend, they work to transfer your accounts to another healthy bank. By Monday morning, your new bank is in place. You can access your money through new online systems, and debit cards usually still work. Sometimes you might get a physical check or a direct deposit refund. But for most people, it feels like switching from one bank to another overnight. You don't lose your insured money, but things can get messy if you weren't paying attention to your account balances. Number four, what if you had more than $250,000 in one account? Here's where things get tricky. The FDIC only covers up to $250,000. So if you had, say, $500,000 sitting in one account, only half of it is guaranteed. You might recover more of it eventually, depending on how much the FDIC can recover by selling the bank's assets. But it could take weeks, or months, or longer. Some business owners learned this the hard way with Silicon Valley Bank. A smarter move. Spread large sums across multiple banks or different ownership categories, like joint accounts, to make sure all your money is insured. Number five, are online banks and mobile apps safe? Here's where people get confused. Not all apps are banks. For example, Venmo, PayPal, and Cash App hold your money, but they're not traditional banks. Unless they partner with an FDIC-insured bank, your funds might not be protected. If you're using a digital bank, always double-check if they are FDIC-insured. Most legit online banks like Ally or Chime are insured, but some fintech apps are not. Always look for that FDIC logo. If it's not there, be cautious. Number six, what about credit unions? Are they protected too? Yes, but not by the FDIC. Credit unions are protected by the NCUA, the National Credit Union Administration. They insure your deposits up to $250,000, just like the FDIC. So if you're with a credit union, you're just as safe. Just look for the NCUA sign. Same protection, different agency. Number seven, can you lose access to your money temporarily? Absolutely. Even though your money is insured, you might not be able to use it immediately after a bank failure. Debit cards may stop working. Online banking might be down. Direct deposits could bounce. Automatic payments might fail. That's why it's smart to keep a little backup cash on hand or a small account at a second bank. Example, if your rent is due on the 1st of the month and your bank crashes on the 30th, you might not have time to fix things before the landlord notices. Number eight, what about loans and credit cards? If you owe money to a failed bank, your debt doesn't disappear. Sorry, The FDIC will transfer your loan to another lender, and you'll keep paying your mortgage, car loan, or credit card bill as usual. The only change: you might get a letter saying to send your payments to a different address or log in to a new website, but don't stop paying. That could hurt your credit score. Number 9. What should you do today to protect your money? Let's make this simple. Step 1. Check if your bank is FDIC or NCUA insured. Visit fdic.gov or ncua.gov and search your bank's name. Step 2. Make sure no single account has more than $250,000 in it. If it does, split it across banks or use joint accounts. Step 3. Keep a backup bank account with a different institution. Think of it as your financial emergency exit. Step 4. Don't rely solely on apps. Read the fine print. If your digital wallet doesn't clearly say your funds are FDIC insured, move your cash somewhere safer. Step 5. Set alerts. Most banks let you turn on fraud or low balance notifications. Number 10. Is this something you actually need to worry about? In short, maybe. Bank failures are rare, but they do happen. In fact, over 500 banks failed between 2001 and 2020. That's about 25 banks per year. And in 2023 alone, 3 major banks collapsed within just a few months. Even big banks are not bulletproof. If a large number of customers panic and pull out their money, even the biggest banks can feel the heat that it's unlikely, but possible. Number 11. Can you see the warning signs before a bank fails? Sometimes that if a bank is losing money, under investigation, or laying off staff rapidly, that's a red flag. Sudden changes to withdrawal limits, interest rates, or policies might also mean trouble is brewing. You can also check a bank's health using sites like Bankrate or Bauer Financial, which grade banks based on performance. But don't obsess. The easiest protection is simple. Stay within the insured limit and use trusted institutions. Number 12. Can banks take your money if they fail? No, not if you're within the insured limit. But if you exceed that limit, anything above $250,000 might be frozen until assets are recovered. In rare cases, you might not get all of it back. That's why it's smart to stay diversified. If you're wealthy, consider using Certificate of Deposit Account Registry Services, DARS, which let you spread your money across many banks while still keeping it insured. Example: a business owner with $1 million in deposits can use DARS to keep every dollar insured across multiple banks. That if your bank fails, don't panic. Your money isn't just vanishing into thin air, but that doesn't mean you should do nothing. Taking a few smart steps today could save you a lot of headaches tomorrow. Let me ask you this. Do you know if all your money is really safe right now? Let me know in the comments below.